Hey everybody, Rob Maurer here, and today we are of course going through Tesla's second quarter earnings report and conference call. We'll start off with the financials, which we talked about a little bit during the live stream earlier today, but we'll go through the highlights here. As we have talked a lot about, all eyes this quarter were on Tesla's GAAP net income. If Tesla was able to post a profit, they would become eligible for the S&P 500. They did do that. They posted a $104 million GAAP net income, making the company now eligible for inclusion in the S&P 500, though they still have to be selected by the selection committee. A decision on that could come within a couple weeks, or it may take a little bit longer, maybe as much as 8 weeks. My guess is that the selection committee has already discussed Tesla because of the stock price performance over the last few months, and Tesla having already posted 3 profitable quarters in a row. This quarter now marks their 4th consecutive profitable quarter, and their first fully profitable trailing 12 months as well. So huge congratulations to Tesla on achieving those milestones. As far as the S&P 500 inclusion process goes, we've talked enough about that. You can check out those older videos, but let's go through the other financials here. If you're watching on YouTube, you can see how the actuals came in versus my forecasts from earlier in the week, and overall pretty happy with how I had forecast. As always, a few areas of variance, and we'll go through what that implies. First up is deliveries. We obviously already had the delivery and production report in early July, but the actuals always vary a little bit from that report. Tesla reported 90,891 vehicles, so about 240 more than they had previously reported. So not a huge difference, but a nice little bump there. Looking at revenues, Tesla reported just over $6 billion in revenue. That compared to my forecast of about $5.9 billion, so 2.5% variance there. How this broke down between the buckets was pretty close on automotive revenue, so $5.2 billion in automotive revenue, right on my forecast there. Energy sales actually came in above my forecast by quite a bit, so $370 million. That was actually higher than Tesla's Q1 performance of $293 million, and 66% higher than my forecast of $223 million. Services and other came in at $487 million, a bit higher than my $435 million forecast, and down quarter over quarter from $560 million in Q1. And then the big wild card, which goes into automotive revenue, is regulatory credit sales. So Tesla sold $428 million of regulatory credit sales this quarter, up from the previous all-time high in Q1 of $354 million. So the first 2 quarters of this year, total regulatory credit sales from Tesla are $778 million. Zach Kirkhorn, CFO, did give us a little bit more information on the regulatory credit sales outlook for the rest of 2020, which I'm certainly grateful for, and I'm sure analysts are as well. But after emphasizing how difficult it is for Tesla to forecast these regulatory credit sales as well, he said roughly they would expect that regulatory credit sales would be about 2 times the amount from 2019 for fiscal year 2020. Regulatory credit sales in 2019 were just shy of $600 million. So for 2020, we should be looking at around $1.2 billion. I would imagine that Zach is being relatively cautious with this guidance because of the difficulty in forecasting. So I'll probably estimate a little bit higher number than that $1.2 billion for the year. But if that does end up being the number, that would mean we have about $422 million of regulatory credit sales left to go for Q3 and Q4, about $211 million per quarter, quite a bit below the levels we saw in Q1 and Q2. Anyway, on that automotive sales revenue line, of course, since regulatory credits came in $128 million above my forecast, but total automotive revenue came in about $50 million below, that means I was too high on my average selling prices for the vehicles. Tesla in the earnings letter attributed the lower average selling prices to mix shift from S and X to 3 and Y, but I already break those out in my forecast, so for me, I was just overestimating the average selling prices on each vehicle, which probably also played a role in my over expectations on automotive gross margin X credits. So if we swing on down to that line, Tesla came in there at 18.7%. That was down quarter over quarter from 20.0% in Q1 and below my estimate of 20.6%. But Zach on the call attributed this fully to the lower efficiency that they had due to the production shutdowns and the idle capacity and restarting of production. That point is extremely important because that means as we move ahead into Q3 and Q4, when Tesla does not have to deal with those circumstances, the margin should rebound to where Q1 was, and even beyond, because remember in Q1, Tesla had to deal with those shutdowns as well. And what we can't forget here is that in Q2, Tesla lowered prices on Model 3, on Model S, and Model X, and then in the beginning here of Q3, they lowered the price on Model Y. Despite all of those lower prices, Tesla was in a position to improve automotive gross margin sequentially if it were not for the forced shutdowns. So just as I said in Q1, people then were not paying close enough attention to the margin performance Tesla had. That's going to be the same case here with Q2 in my opinion. People are going to look at that decline quarter over quarter. They're going to point to the regulatory credit sales being at an all-time high. But there is a sleeping giant here because what Zach also said is that they continue to improve their margins on Model Y and in Shanghai. And Elon made a couple of important points on the Model 3 out of Shanghai. Number one, they are increasing their local sourcing by 5 to 10% every single month. That drives costs down. And then secondly, and very importantly, he said that Tesla's efficiency throughout their powertrain and their HVAC system and everywhere in the vehicle is now high enough that they feel good about using lithium phosphate cells, and they'll be ramping up Model 3 using those cells in China later this year. So that's something we've talked about, but as Tesla does that, that's going to help them lower costs as well. So you combine that with the increasing cost efficiency from higher production rates and the cost efficiency of local sourcing, and you have a really good outlook for margin from Shanghai. Not all of those factors apply to Model Y, but it's in a similar situation too as production ramps up to improve its margin. And then Tesla's whole entire business is going to swing back to being more efficiently run without having to deal with these shutdowns. And we just have a massive gross margin sleeping giant here that is ready to show itself in Q3 and Q4. So even though Tesla did fall short of my automotive gross margin X credit expectations, I had talked about the impact of the shutdown being a big area of uncertainty for me in my forecast. So Tesla attributing the margin decline sequentially to that is exactly the reason that I would be hoping for. Profitability on the other business lines was a little bit better than I expected in combination, really driven by services. The margin there was a negative 14.6%. As Zach noted on the call, this continues to improve quarter over quarter, meaning they are reducing their losses from services and other revenues, which is really great because that's actually been over time a pretty big drag on Tesla's total gross margin and their operating margin and thus net income. For context, in the first half of 2019, Tesla lost about $330 million on services and other. In the first half of 2020, that loss has been cut in half to about $160 million. I think that would be attributed to a couple things. Number one, obviously just Tesla's continued focus on cost controls. Zach talks about that on every call, wisely. And then secondly, Tesla is starting to have vehicles that are coming off of warranty, so every service appointment isn't done at a loss like it used to be. Still, if you are growing production, more of your vehicles are going to be under warranty than another automaker, for example, so you're still going to have a relatively more difficult time with breaking even in that services and other business. Anyway, all said and done, that total gross profit line came to $1,267 million. That ended up being $57 million higher than my forecast, but again, there was a $128 million variance in regulatory credit sales, more than explaining that overachievement, plus the fact that Tesla had about $100 million more revenue than I had forecast. So if we stripped out credits, my margin would have been a little bit lower due to automotive that we just talked about, but including credits, Tesla came in at a 21% gross margin, growing margin quarter over quarter by about 40 basis points. Next in the financials was operating expenses. I was pretty close on research and development, about $15 million off on that. Selling, general, and administrative, I was off on $120 million here. I think the reason for that was Elon Musk's compensation package. Tesla said that had a negative $100 million impact, which I did account for in my non-GAAP earnings estimate, but I think I might have missed it in operating expenses. I still need to learn a little bit more about how that's actually accounted for. So overall, operating expenses came in about $100 million higher than I had forecast. Operating income then was $327 million, coming from the slightly higher total gross profit, but coming in under my operating income forecast of $375 million due to those higher SG&A costs. That put Tesla's operating margin percentage at 5.4%, up sequentially from 4.7% in Q1, but short of my forecast of 6.4%. Down to the earnings lines, I have earnings before interest and tax, depreciation, and amortization at about $1.2 billion, 1.225 to be exact. Tesla came in at that $1.2 billion, so I was only $16 million off on EBITDA, which I'm really proud of. Non-GAAP net income, I was about $20 million off here. Tesla posted $451 million. Non-GAAP, I had estimated $423 million. GAAP income came in, as we had talked about, at $104 million versus my forecast of $145 million. And these numbers led to earnings per share on a non-GAAP basis of $2.18 versus my forecast of $2.29, and GAAP earnings per share of 50 cents versus my forecast of 78 cents. The biggest miss I had was on free cash flow. That came in at a positive $418 million, so more than $500 million above what the street had forecast, which I was very confident that Tesla would beat, but falling short of my estimate by quite a lot. It sounded like from Zach on the earnings call that a lot of this was driven from regulatory credits. Tesla can recognize that as profit before they actually receive the cash, and it sounds like that cash collection on those credits has been a bit slow the last couple of quarters. I think that was a major contributing factor, and then he also talked about some things with accounts receivable that I think we'll just have to take a little bit closer look at when the 10Q is filed. So that wraps up the financials. I spent a little bit more time on this than I had planned to, and I am running out of time here, so I do just want to hit a couple other things. Obviously, they announced Gigafactory Texas. Huge news there. Elon said that they already have started initial construction work as of this weekend. So Tesla is now growing operations at 6 factories as far as we know. We have Gigafactory Nevada, we have Fremont, we have Giga New York, Giga Berlin, Giga Shanghai, and now Giga Texas. These factories that are already being built out are factories that are going to allow Tesla to have vehicle production capacity of 3 million or 4 million vehicles annually. Obviously, it'll take some time to get there, but when we look back in hindsight, it's going to have happened extremely quickly. All right, unfortunately, that is where I have to wrap it up for today. We will still revisit some of these topics. There's still a lot on earnings that I want to talk about, but that is where we have to leave it for today. So as always, huge thank you for listening. Don't forget to subscribe and sign up for notifications. Make sure you're following me on Twitter at Tesla Podcast, and I'll see you soon for the next episode of Tesla Daily. Thank you.